Hello, my name is Dr. George Mochocki, and welcome to Finance 225 International Finance Management, offered by Harper College. Um, you're either taking me in an online class or face to face class, and this is a supplemental flip the classroom, a summarization of what we already discussed in the lectures, or with the homework assignments, or in the discussion board if it's an online class. You will remember, you always open up my concept maps, and you find that in Blackboard course management system that Harper College utilizes. Print it out. When you read the book, add on to my overview outline that follows along with the chapter reading from the author, from the publisher, and then add on your own words. And then after discussion in class and everything else, doing the homework. And now at the end, you're just taking this as a summarization of what you've already learned and discussed and going forward. So hopefully you'll remember everything. We're on chapter 18. We only have 3 more chapters to go. You're almost at the end. This chapter has a lot of terminology and a lot of concepts, less and less math problems or equations as you're going to the end. Is now that you actually understand the conceptual. We'll discuss previous chapters that we've had. If you somehow stumble on this YouTube, and so call up Harper College in Paulton, Illinois, and say, hey, I want to take Dr. George Mochocki's class. I saw his YouTube, and I teach other classes there. I'm a contractor, an adjunct lecturer for the college at Harper College, and also at College of Lake County. All right, so let's get going on this. Remember, this is not the first exposure, so I will be going over. We discussed this, we did everything else, so you need to have the book. You need to read the examples. You need to read it first, discuss it, and now this is like a summarization. All right, so let's look at it. So what are we going to talk about? We're going to be talking about long-term. This is chapter 18. We'll be talking about long-term financing. We're going to be talking about financing to match inflow currency using currency swaps, parallel loans, debt denomination. We already had that, standardization of swap markets, other types of interest rate swaps, hedging. We've had that. Remember, we're coming to the end. At the end, you're going to have more of a conceptual idea. There's still some equations, some problems you're going to be doing, but there's more to understand the terminology. What I want you out of this class, because the community college is a baseline first exposure to international finance. I want you to learn the terms and concept. There's a lot of them. The math will come later on. You've got the calculator spreadsheet. I'm not too worried about that. You have to understand what's going on in the market and why it's reacting this way in the international market. And remember, we're looking at this from the perspective of a MNC, multinational corporation, operating subsidiaries. So if you're a small business or medium business, or even if you are an MNC, this is a good refresher course. This is also a good professional development class, and it's also a transferable course. So if you're not close to Harper, look up at your local community colleges. A lot of them will offer this course, and you get the best bang for your money and at a reasonable price, and they'll give you a good, solid foundation. Okay, so let's talk about. We'll go right into this. And those of you, by this time you already had me, know me. I keep on repeating the same thing because you never know. It's nice to know what's going on. So, okay, so again, I'm using color coding in here, and the color coding is these would all fall underneath this header: financing, matching, inflow of currencies, currency swaps, all that, a different strategy, parallel loans. So that's one, A, B, and C. One B, one C, and so forth. And the next header, the big header, is debt denomination, and those are beyond it. And the reason I did that, because when you print the concept maps, it'll be too small. This way, it gives you a little more area to add in your own notes. Remember, some students, it's a PDF file. You can make it larger into different chunks. So far, as students looking at this is about like 40, 50 slides, all in 2 sheets or one sheet to give you the main idea. If you never read the book, never went to class, or never did anything else, and just saw this YouTube, it'll give you some basic understanding, but you'll never really conceptually, thoroughly understand the subject matter unless you're in the classroom and looking at all the material, all the things to understand this. Okay, so let's go on the first one. And I always try to keep it underneath an hour. I've been doing pretty good on that. give or take, cross my fingers. Okay, financing to match currency inflows. Again, when I'm looking at this, the main things on here, multinational corporation, that's the perspective we're looking at. So, a multinational corporation, MNCs, typically use long-term, excuse me, sources of fund to finance long-term projects, matching strategies. Okay, the matching strategy is desirable when foreign subsidiaries are based in the countries where interest rates are relatively low. Remember, this makes sense. Now you say, oh, now I understand this, all right? Okay, can reduce subsidiary exposure to exchange rate movement. If I ask a question, can how would you reduce the subsidiaries exposure rate to exchange rate movement? You would go, oh, I could use their financing to match currency with the inflows. Using a matching strategy, it allows the subsidiary to use a portion of its cash inflows to cover cash outflows. I look at inflows as here's my paycheck, and outflows is my bills. So it works both ways. Now this way, you're looking at inflows coming into the MMC. The whole theory, the whole concept of everything else is to take care of the parent MMC. The subsidiaries are there. We talked about agency costs and all this other stuff. That's duplication, similar to what happens in the domestic market. But now we're looking at international market. If you only got one subsidiary, it's easy to manage. But after a while, as you're growing, because the world is flat, for lack of better words. Christopher Columbus wasn't too well off on that, but the world is flat economically because we're all one economic global system. Okay. All right, so now we took care of that. So, okay, so I'll close that off. The next one is using currency swaps. A lot of this we already talked about previous chapters. Now we're just reinforcing it and looking at the long-term financing and how do I use the swaps for long-term, because you use this for short-term or long-term. Using currency swaps to execute the matching strategy that we talked earlier up in here. Maybe I'll leave it open just in case I got to go back and forth. When foreign subsidiaries are based in countries where interest rates are low, okay? So I'm always trying to remember, my whole thing is not to get those abnormal spikes, those big profit. That's nice. We all love those. But mine is as a chief financial officer or strategy is for the MMCs that they always have enough cash flow going in there. I have it here, and everyone has enough. I like to make some money, but not these big spikes. I can't plan. I can't manage all my facilities, paying my bills, my expenses, unless I have a constant of a flat. Even though I have my spikes in real life, but I try to flatten out as much as I can. That's why I do the hedging, the forward contracts, everything else that we discussed in previous chapters. Okay, so let's look at this using swaps for currency. Okay, now this is just and if I'm looking, just follow the arrows. Dollars received from ongoing operation goes back corporation, goes into the Miller Corporation. Euro received from ongoing information operation. You have two. So remember, I'm looking at swaps matching different strategies, dollars investment. It makes sense when you have to look at the scenario. What is going on here? And they'll talk. And when you read in a book, I can't go over it all because I'll be longer than an hour. I have a lot of information. So look at the illustration, read the author. He does an excellent job. The book explains it. I'm just summarizing it. So we already talked about this in the classroom. So let's just move on here. An MNC faces exchange risk when it is not able to in which it receives most of its all revenue. Remember, you got your inflow and your outflow, or all of its revenue the same currency as its invoice currency. Okay, this makes sense. And the reason some of the sentences doesn't look right because I eliminate a lot of words. I try to minimize it. Okay. Okay. So what's a currency swap? A currency swap specifies the exchange of currencies at a periodic intervals that may allow the MMC to have cash outflows in the same currency which it receives most of its revenue. All I want to do is make sure is my outflows are in the cash that it's nicer when I get the same currency as my inflows and outflows. But that's not necessarily always the case. but depending on all the different factors we talked in another chapter. Just as a quick general overview. Okay, okay. Now using parallel loans, similar but a little bit different, to execute a massing strategy. Now, if I'm looking at parallel loans, now I got two exhibits here. Ann Bush parent that has a sub in UK, and British parent that has a British MMC, a British MMC parent in UK. When I'm looking at a parent, I'm always you've been with me long enough for all these other chapters to 18. You know when I'm talking about parent, I'm talking about the MMC, the main corporate headquarters of all the subsidiaries, for lack of a better word. Well, what happens in Britain, they have a corporation, the parent has a similar MMC, a subsidiary, and in the U.S. has it. So the Britain, look at this. This one here is over here, the subsidiary in British, and this one's in the UK. So what they're basically saying is, I would take a loan out in here from the British parent to help out my subsidiary in Britain from the U.S. parent. So I'm doing basically a parallel loan. I have two operations, and I'm paralleling it across to, for lack of better words, to offset one over the other without moving my currency back and forth, because it makes sense. I keep it in here, so I'm not. It minimizes me from any kind of exchange rate or anything else, because I'm utilizing it within that. What do they call it? I'm taking out the loan in that host country that I'm operating my subsidiary, not where the parent's at. So I got two parent operations, two different locations, and I try to do a parallel loans between the two, which makes sense. Okay. Read it. Like I said, when I'm looking at this and seeing the next exhibit, when I'm looking at this exhibit, it tells you the dollars. And here's what you need to read: the scenario on what's going on. It's on page 548. Chanel's looking at MR dropping $20. So real quick, here is when I look at the exchange rate for like Malaysia ringgit. Okay, it's 25 cents, but I know when when I'm going to be bringing it back, it's going to be at. Okay, we're back on. All right, good. I had a little delay in there, so let's see what's happening. I'll put this back in here. Let me just close this off. Close window. Okay. Remember, so you have to look at what's going on. So because of this drop, when the money is going to be coming back, dropped, usually they were looking at a 13% return on them coming back to the Malaysian government. All right. So, but then since there's going to be the change of the exchange rate inflation, the drop for 0.05 cents, for lack of better words, a U.S. currency, there is going to be. I lost my train of thought. There is going to be. I got to make it up at the end, so that's why you can see the 15%. It makes more sense when you read the scenario. I'm just giving you an example. This is a summarization. We talked about this. Okay, almost forgot what the example was on here. Are we good? Okay, so the next one we're going to look at is debt denomination decision by subsidiaries. Okay, excuse me. Okay, so now the subsidiary debt denomination. How's my debt, and what kind of currency am I going to be paying? Depends where the subsidiary is at. So subsidiaries of MMCs desire to match the currency they borrow with the currency they use to invoice the products. It just makes sense. It's easier that way. That's what I want to be paid in that type of same denomination. The cost of debt is dependent on the local interest rate of the host country. Okay. Now, subsidiary in the host country, okay, where interest rates are high, might consider borrowing in a different currency in order to avoid the high cost of local debt. Okay, remember, it all ties in. And see Exhibit 4, and then here it says, Exhibit Annualization Bond Yields Among Currencies. That's 2009. I know it's a little old. It just tells you which ones are higher and which ones are lower. So it tells me where I'm going to do my, for lack of better words, here we go, parallel loans, or am I going to be doing a currency swap, or let's see, currency swap, where the heck was it in here? Oh, here it is, a massing strategy. I was trying to find it to you. All right, so remember, when you have your concept maps, look at it, go all over it, look at it, and go back and forth. That's the ideal of the mind map. It's there. It's a little harder here because I have it open so you could see. Usually when I'm talking in a classroom, I'll have it or I'll have it in front of me so it's easy to see moving along, just like you'd be doing, okay? All right, so now we've got through all that. Okay, so we have this. Do I have anything else in? Okay, we went through that. Okay, here's where we're at. Okay, so we finished this. That the denomination decision by subsidiaries. Okay, real quickly. Wasn't too bad. Look at the things. It's a refresher. What's going on? Which way is the money going? The loan going back. You'll follow the arrow. See where it starts off. Look at the parent. You have alternative one, alternative two. Discuss in the classes. I may have a chart out there and ask you what's going on. Which one would be better. It depends. I'm not sure yet. Yeah, because I know there's for the exam. Everyone's asking me about the exam now. What's going to be an exam? I'll try to have more. The multiple choice questions I'll have there because it's more of a definition introduction class. But I'll try to have some short answers. That's where I could students rack up more points. If you miss it wrong, there's a lot of definition. You miss one wrong, it's easier. At least I'm trying to understand. Do you understand conceptually what I'm trying to say to you? Okay. All right. Okay, so let's look at this. And now we're in 2B, right? We went with 2A, 2B. Debt decisions in host countries with high interest rates. And, I'm using colors here, but when I do I found out when I do the PDF files and I save it, for some reason the colors, some of this is not coming out. But that's kind of good. I thought about doing that, but maybe you should just write it in. And, the more you use your senses, the better you do. Okay, so here's debt decision in host countries with high interest rate. What do? Comparing financing costs between debt denomination. We're English second language, so if I say debt, it's not debt, it's depth. Depth. Always had trouble with that tongue. Try to speak Polish for a while. Okay, subsidiaries based in developing countries may be subject to relatively high interest rate. We talked about that. We've got the massing strategy would force MNC subsidiaries in developing countries to incur high cost of debt. What am I trying to do? Minimize the cost if I have to. I'm looking at the whole total yield. What's the cost of doing it? What's the all the different factors we talked about. Parent of a U.S.-based MMC, remember we discussed this in class, may consider providing a loan in dollars. When I go to dollars, it's usually U.S. dollars to finance a subsidiary. Let me go this way a little bit. Okay, define as a subsidiary so the subsidiary can avoid the high cost of local debt. Okay, but here's a caution. What you have to know. This will force the subsidiary to convert some of its funds to dollars in order to repay the loan. So now I'm still doing I'm trying to do that conversion, trying to minimize that while I'm already in there. Right? That decision hosts countries with high interest rates. Okay, combining debt financing with forward hedging. Forward contracts may be available in some currencies for 5 or plus years. Okay, and I look at forward contract. Is future loan payments in a particular currency may allow a subsidiary to hedge. And now the hedging strategy may not allow the subsidiary to achieve a lower debt financing rate it could achieve by borrowing its host country's currency. Remember, there's a cost associated, but it's so high, so I may break even, but there's a risk involved in this. Okay, comparing financing costs between debt denominations. Exhibit 6, let's have this. So you have the different 1 year, 2 years, the US dollars at 7%, forecast exchange rate of the pesos, right? Pesos need to repay the loan in year 1, year 2, and year 3. Mexican peso, 15, you see it's going up, all right? Peso loan versus a dollar loan to foreign subsidiary. So you're looking at the numbers and see what's going on and see, stop the video now, open it up and look at it. I can't do justice by doing quickly because I'm rushing to get this done within an hour. Okay, where interest rates are high, it must estimate the financing costs for financing alternatives. Okay, accounting for uncertainty. Okay, accounting, we're on number 6. These are some of the options. Remember, debt decisions, another option you can look at. Accounting for uncertainty of financing costs. The subsidiary can account for uncertainty surrounding its point estimates, exchange rate forecast by using sensitivity analysis. We had that several chapters back. I can't remember out. So sensitivity analysis is looking at the factors that are affecting it, and I have different analysis for different scenarios. Okay, which it can develop for alternative forecasts. What do I think? I don't have a crystal ball. I don't have a time machine. Maybe somebody does. I don't have it. So I'm doing the best, my best method, and it's usually a mixed method. You find it's not one that is all inclusive. It's a mixture. It's kind of like a concoction. I'm looking at different strategies, different ways of analyzing to make sure before I go forward. And then I'm learning, but I have to always keep a pace what's going on with other factors, external factors, internal factors within that a region or that country or that market that I'm operating in, which can develop alternative forecasts for exchange rate for each period in which the payment will be provided. So if I got 3 years, those are different periods, how I'm paying it. I have to look at what do I think is going on. If I know some rules are coming in, there's something that's going to happen, there's going to be an increase. In the next year, I will have to make those adjustments. Just because I have the analysis, I'm always making adjustments to make sure I'm on track and do I need any adjustments. Just like you're driving a car. You can't just drive fast. You got to slow down. You got to move around. You got to do some adjustments. Look at it this way when you're strategically planning going forward, and this is long-term planning. So I can't just say it's done and hope it works. It doesn't work that way. You have to be always involved. Okay, an MMC can apply simulations, okay, which it develops a probability distribution. Those of you, that's why you're taking probability, taking algebra, taking a little bit of geometry, stats to understand the probability, the confidence level, okay, or finite math. Once in a while I'll teach. It's all, to me, it's all math, all combined. You just categorize it, which it develops a probability distribution for exchange rate for each period in which the outflow payment will be provided. All right, so took care of that. Okay, now the last one is debt denomination to finance a foreign project. Input necessary to conduct an analysis. Spot rates. Remember, this are all refresher. At the end, man, I'm beginning to understand it. Interest rates for each currency available. Expected revenues and operating expenses. Let me just make this just a bit bigger. I think this will work. No, 300 be too big. No, yeah, a lot easier for me to see. A lot easier for you to see if you're looking at it. Hang on a second. It all depends on the maps, you know what I mean? So if I'm looking at it here, let's see if I just go 275. I know there's a button in here I like to, yeah, that's much better. Okay, so I've already talked about, spot rate, interest rates, expected return on operating expensive initial investment needs. We always talk, all the yield, everything is going to cost me. I don't care if it's even a little penny. You're in finance. You manage every penny. You don't lose anything. You start losing pennies, you start losing quarters. This is finance. Okay, analysis of financing alternatives for a project. Remember, this is no different. I have already under the assumption you've taken corporate finance and already had some accounting classes. If you haven't, you could kind of struggle through because it's more of a definition concept courses, but it's going to be way over your head. So make sure you've taken some of those other classes before you. Well, it's a little bit too late now. All right, you're already at the end. We're going to talk about chapter 18. But those of you just picked it on and say, hey, I want to look at the other ones and understand that, start from the beginning. At least take the basics and going forward. Okay, so analysis of financing alternatives for the projects, applying capital budget analysis. Okay, capital budget, let me do it this way. Remember, I'm live in here, so I'm not reading off a script. I am kind of, but not kind of. Applying capital budget analysis to each possible financing mix, a subsidiary can determine when financing the mix. It's supposed to be a duh. Remember, highlight just a key word. You've read it, you know it, highlight the key word. I put everything in here because it's easier for students to read, to follow. Because if I just tell you a parable, for lack of or a story about it, figuring to the conceptual, but I don't. I may not utilize all the concepts and vocabulary that you're going to be tested on. So you have to know the definition. So we'll go through this. I'll look at this, and this is a good tool to learn that. Will result in higher net present value. Okay, determine which financing. Net present value is what I'm looking at now, how much money I could get. Remember, the net present value in finance is the molecule. If you're looking at anyone that's looking at biology or in chemistry, I guess in biology and everything else, it's a molecule. So net present value is the heart of finance. Okay, and here's Exhibit 7. And then you have the different things. So look at it. Rely on U.S. debt. 20 million borrowed. Rely on Argentina debt. Pesos. And it gives you. Remember, we talked about this in here. If you're looking at that, you don't stop. See what's going. Look it back. Figure it out. Not sure, go back to the author, go back in the book. He will have it. You'll have in the concept, and you'll read it, and now we understand. I can't go through all this. I could spend a whole hour in one graph. I try to move along, okay? Based on two financing alternatives. That's what they're basically looking at, okay? Adjusting the analysis for other conditions. The analysis can easily be adjusted to account for more complicated conditions. We already know that you have to adjust. No problem. Let me just go back in here. I'll go do 250. Because I know when I go back in the other one, 250. Okay, sorry. I just got to get the right mix on here, class. Sorry. All right? Just like I'll be doing in the classroom, I do my small adjustments here. All right, so we're doing pretty good on here. Let me just close all these off as I move forward. So when I end this, we're done. What the heck? Oh, okay. All right. Let's see what we have. Let's move along here. No, we're not doing too bad. We only have a few more items to do. And sometimes I'll leave this open as I go. If I use the program, there we go. Okay. This makes it easier for me. All right, let's look at the debt maturity decisions. Whole new topic. This one's only have a few items on here because it's all by itself. Then we go to fixed floating rates and then summary. Almost make my hour. Okay, so let's see. Okay, an MMC must decide on the maturity for its debt. Assessment of the yield curve that we talked about in previous chapters. The shape of the yield curve can vary among countries. Remember, if I said, will the shape of the yield curve always be the same? If it's a true and false question, you can say no. An upward sloping yield curve may indicate that investors require compensation for illiquidity associated with long-term debt. Okay? Now, financing costs of loans may, with different maturities, must decide whether to obtain a loan with a maturity that perfectly fits the needs or one with a shorter maturity if it has more of a favorable interest. So remember, we're talking about long term, but I may want to look at a short term because two short terms, it may be to my advantage with the bottom line. Remember, the whole thing is to bring added value to my shareholders from the parent MMC. Okay, and then additional financing when the loan matures. And in here they have Exhibit A. Let's say Exhibit 8. Let me move this over here a little bit. 5-year loan or 3-year loan, and if you're looking at the repayment and see which one makes out better. 3-year loan, repayment 3 years and 5 years. Loans on different maturities are made to foreign subsidiaries. Whew. Not doing too good here today, Georgie. All right, let's see. Now this one here, the next ones, these would be all underneath the same header: fixed rates versus floating debt decisions. So it's easier, so I just split it out. That's why I have it this way. Okay, so let's do it in the first one, and this one's not. Let me close some of these off. Okay. So MMCs that wish to use long-term maturity but wish to avoid prevailing fixed rate may consider floating rate bonds. And here's an exhibit you can look at. And again, stop the exhibit, float it out. Remember, you do your expand it, look at it, or look in the book, or because some people, I think with this one, some students are utilizing the ebook, electronic version. Now, here's the way I look at it. When do you want the ebook, even though that's where the publisher's going, and when do I get a hard copy book? Usually the hard copy book. Okay, when do I do that? If I'm doing math and anything else, I need to flip back and forth. I need to go back and forth. I would basically get the hard copy or print it out or get the loose sleeve and then use the ebook for studying, but it's easier going back and forth. I know you can do the search. It's easier for most people. And if you're just doing like casual reading, sometimes you'll take me for management or HR or advertising, as long as, you know what I mean, or marketing, or even personal financing. On those you may be able to get away with just by the ebook because it's more just conceptual, just concept. When you have to do math and everything else, it's easier to look at it in front of me, and I could go back and forth, highlight it. Okay, and this is the Swiss francs that they're going to be looking at. That I was going to say San Francisco, but Swiss francs. Okay, I'm just kidding. There's a lot of look, and here's what happens. A lot of people say, "Oh, I have to remember all of the different denomination." I will let you know in the tests and the exams. It'll spell out which denomination you use. You don't have to worry about that. Most people can't remember all of them, unless I'm being exposed to. I know the Mexico. I know the Ruby. I know. All right. So when you're looking at that, but you will understand thoroughly where your subsidiaries are at. That you have to understand. You don't if you don't have any subsidiaries in China, unless you're doing some other kind of a swap or something, or doing there with the yuan, you more should be concerned on if you're doing something in this case in Switzerland utilizing the franc. You should understand the denomination and everything about the Swiss francs. So that's where your subsidiaries operating. And that's usually after a while you know the rest of them, but you are thorough in the ones that your subsidiaries are at, because that makes a big difference when you're bringing inflows and outflows of uh, cash. Okay, now remember we're talking about long term. So financing costs of fixed versus a long term. And here's if an MNC considers financing with a floating is adjustable rate for lack of better words, it can first forecast the rate for the first year that will determine the expected interest rate it would pay per year, allowing to derive forecasted interest payment for all the years of the loan. Okay, so I'm looking at the first rate and I'm making my adjustment. Now, if I look at the Libor rate, and this was in here because there was there's some little fixing of the rate. So I want to look at the Libor rate if I'm looking at the discount rate that the central bank provides here in the U.S. But now the Libor rates, the floater rates, are often tied to the London interbank offered rate. Is the average interest rate estimated by leading banks in London that the average leading bank would charge if borrowing from other banks. It's just an average. That's what the Libor. But if someone's playing with the averages or the numbers that create the average, I could have an inflated rate that's benefiting the London internal bank or the Libor. Right. So it has a ramification if there's any adjustment. Remember, we're looking at, even in the globe, we're looking at the market is controlling this, not individuals, even though there is some direct and indirect by government, but overall. I'm not going to get into the China with the yen, what they're doing. They're having a lot of things with the stock markets affecting even the Dow Jones and a lot of mutual stocks here. You look at because they have, the currency's tied with the yen, or and they're bringing it in, so it has a ripple effect across. When one is adjusting, devaluating to improve their exporting. Now you have other countries that are doing the same thing, devaluating. So now which is good for me as a consumer. It's not good for my currency if I'm trying to do some capital investment or paying off some debt. Okay, so I took care of that one. Now the next one we're going to go is hedging interest payments with interest rate swap. We discussed that in previous chapters, and now we're just going to, let me just bring this in so you see it all in one. And remember, this is all tied to long-term debt financing, so you don't forget. Okay, and now we're looking at hedging. If the MMCs are concerned that the interest rates will rise, they may complement their floating rate debt with interest rate swaps to hedge the risk of interest rates. Straightforward. Financial institutions such as commercial and investment banks and insurance companies, those are large ones that usually are investing, okay, often acts as dealers in interest rate swaps. So they're the ones that you have to, they're my intermediaries. If I look at a distribution change, and if you look at currency, the banks are my intermediaries, part of my financial distributional change. Plain vanilla interest rate swaps. One participating firm makes fixed rate payments periodically in exchange for floating rates. Remember, it's an agreement, finance, contractual agreement. We've talked about that. Look at it. Think about it again. If I ask you a question about that, what's a vanilla interest rate swap? So I might just throw that in there. Oh, all right. I don't want to say what some students would write, vanilla, asterisk, whatever, but interest rate swap. This is the terminology. I want you to know. The payments are based on a notional value. Now, when I look at it, what's the notional value? Let's go on here. What do I have there? Okay, let me flip it on here. I got a little YouTube, and remember, I like using this just because it gives me a little more. Okay, so a definition notional value. I move this over a little. Okay, okay. So if I'm looking at it, I'm looking at which one is real? Okay, so definition of a notional value: the total value of a leveraged position assets. The term commonly used. Okay, so where was it? Excuse me. This term is commonly used in option, futures, and currency markets because a very small amount of invested money can control a large portion, have a large consequences. In Investopedia, for example, if one SPS, Standards and Poor's 500 index feature contract obligates the buyer to 250 units of the SP's, Standards and Poor's 500 index, if the index trading is at 1,000, then the single future contract is similar to investing 250,000 and 1,000. Therefore, is a notional value underlying the future contract. Very good. Now let me show you this. I think this video is only like 1 minute. I'll be quiet.
Notional value is a term used in derivatives, options, and currency exchanges. It refers to the total value of the assets in a leveraged position. For futures contracts, it is the contract size multiplied by the current spot price per unit. The contract size is the number of units a typical futures market contract controls. For instance, a futures contract for crude oil controls 1,000 barrels of crude oil. Therefore, if the spot price of a barrel of crude is $80, then the notional value of an oil futures contract is $80,000. Marginal requirements for futures contracts are set with notional value. A margin purchase is a leveraged position since the purchaser is only required to put up a percentage of the notional value at the time
So
he
taking out
enters
a
into
loan
the
on a
futures
house.
contract. In the crude oil example, if the margin requirement is 5%, then the purchaser is only required to have a minimum margin of $4,000. 5% times $80,000 notional value in order to control $80,000 worth of crude oil.
You see where it started a
derivatives
smaller
such as
amount?
interest rate swaps, notional value is equal to the amount used to calculate the payment. So if ABC Bank traded a $1 million 5% fixed rate loan for XYZ Bank's $1 million variable percentage rate loan, the notional value on this trade would be $1 million.
Pretty good? All right, very good. Let me just stop that. Okay, let me just close this. I threw out a video so you don't have to listen to me. Okay, okay. Now, and this one here is it basically will go through the same thing. Again, stop it if you're not sure. Play the video back, or go back to the author. All right, so it gives you a visual presentation. I like the video because it's actually more animated. Most of my students like the animations on there. Okay, so limitation of interest rate swaps. What do we have here? There is a cost of time and resources associated with searching for a suitable swap candidate and negotiating the swap terms. Each swap participant faces the risk that the participant could default on a payment. Remember, I'm going to do a minimum. There's always that risk they could default on there. So I get it back. Okay? All right, take care of that. Push this one back.